Joining me now is Lebas, one of Bloomberg's best economists. Bloomberg Best, to remind you, we have crunched all the numbers to bring you only the most accurate forecasters, and Guy certainly fits the bill as one of our highest ranked in several categories. Welcome back to the show, Guy. Always great to see you. Like to begin with Greece. Greece will get a bailout. That's the headline today. Do you believe the worst is over?
Well, I think a lot of the worst is over, but really once the situation started breaking more heavily in February, there were really only two options. One was for Greece to default on the debt. The other, and kind of the opposite option, was a bailout. And the reason there were only those two options is because the markets turned negative against the country. And until we see that really turn, we don't have a full conclusion to these events.
Can you look at the markets in Greece? You know, stock markets rose in excess of 3%. Bond yields are a little bit lower as well in Greece. Is that telling?
It's telling. It's certainly a sign in the right direction that the country can sort of accept this bailout and perpetuate their current economic status. But it's not the end. It's not the final conclusion, because we really need to see spreads on publicly traded Greece debt compress a lot before we can be confident the markets are really accepting them.
And can you look at spreads between, I know this isn't a benchmark by any means, but with what's going on with U.S. rates? And if people are looking to us as a safety play?
Well, we definitely saw back in February in particular, when some of the Greece concerns broke, a lot of inflows into Treasury debt. We saw a big rally in the Treasury markets, particularly around the 10-year area. This last round of concerns really hasn't been brought with it. It hasn't really brought the Treasury markets with it to the same degree. I think the world is sort of separating out Greece from other entities, from the U.S. markets more recently.
All right, so I want to leave this as a very open-ended question here, very broad question, so we can really drill down on the forces driving U.S. rates. So what is behind the movements in the U.S. Treasury markets? We've had a week of pretty good, especially the 10-year bond auction came in great this week.
Yeah, we have had a series of good auctions. Now I'm going to take a look back maybe about 6 months or so ago, and that's really when talk of higher Treasury issuance, higher rates down the road really started to push through into the markets. Well, despite this talk, the truth is that Treasury yields really aren't all that much change. We're pretty much in the same place we were in June of 2009. And I think it's very telling that not only are there upward pressures in rates that are kind of a long-term phenomenon, we also have the Federal Reserve and very, very heavy buyer demand in the short term, keeping things pretty well anchored. I think that's probably going to persist for at least another 6 months or so.
So then where would you expect the most volatility, if any at all, listening to you, will be along the Treasury yield curve?
I think the most volatility is really going to be between the 2- and 3-year area of the curve and the 5-year area of the curve. There are a couple of reasons for that. One, with really short-term rates, 2 years and in, the Federal Reserve is keeping them anchored with their very accommodative policy. But when you take a look at the scenario from 5 years on out, economically speaking, we don't have a lot of information about what the world's going to look like then.
Okay.
So we're sort of in a holding pattern there, too.
Guy Lebas, Janney Montgomery Scott, fixed income strategist there. Many thanks.